On Wednesday, September 10, 2008, Lehman Brothers told the market its reported liquidity pool was holding steady at about $41 billion. 2 days later, Friday, it had less than $2 billion it could actually turn into cash. By Monday, it couldn't open for business. The popular explanation is that subprime mortgages killed Lehman, but subprime describes the losses. It doesn't explain how a firm reporting a $41 billion liquidity pool on Wednesday was effectively out of cash by Friday. The real answer is simpler and stranger. Lehman financed assets it couldn't sell quickly with money that could leave almost overnight, and the two numbers that should have exposed that risk both made it look smaller than it was. One understated how leveraged Lehman had become. The other overstated how much it could readily turn into cash. For most of its life, Lehman looked indestructible. It was founded in 1850, 158 years old. Older than the Federal Reserve itself. At the end of its 2007 fiscal year, it reported $691 billion in assets, resting on about $22.5 billion of equity, and it told investors its net leverage was 16.1 times. That number mattered more than almost any other, because leverage was how the market measured how much room Lehman had to be wrong. The trouble was where the money had gone. Lehman had pushed deep into commercial real estate at the very top of the market. In October 2007, it helped take the apartment giant Archstone Smith private, a transaction valued at roughly $22.2 billion, alongside Tishman Speyer. These were big, illiquid bets on property, made just as American housing began to turn. Here's the problem with assets like that. A skyscraper, an apartment portfolio, a mortgage no one wants to buy. You can't sell them in an afternoon at anything close to full price. They're long dated. They take years to work out. And Lehman had a lot of them. On its own, that's survivable as long as you have time. Lehman's problem was how it paid for them. Lehman financed those years-long assets with money that had to be renewed constantly, often literally overnight. It used the repo market. You hand over securities as collateral, borrow cash against them, and buy the securities back the next day. Then you roll it over and do it again. That works beautifully until the day your lenders get nervous and decline to roll. So, the two numbers the whole market watched were Lehman's leverage and its liquidity, which made those the two numbers Lehman most needed to manage, because Lehman could survive bad assets if it had time. What it couldn't survive was letting the market see how little time it actually had. Here's a detail that tells you how far Lehman was willing to go. To make the leverage number smaller, Lehman used an accounting maneuver it called Repo 105, but it was unable to obtain a United States legal opinion supporting true sale treatment for the transactions. So it routed them through its London entity under an English law opinion from the firm Linklaters. By the second quarter of 2008, it was moving more than $50 billion this way. Start with an ordinary repo. You borrow cash against securities, agree to buy them back, and account for the whole thing as secured borrowing a loan you have to repay. Repo 105 was structured to receive different treatment. Lehman handed over securities worth at least 105% of the cash it received, 108% for equities, and under the English law opinion it was relying on, and the accounting rules then in force, transactions built that way could be treated as true sales rather than borrowings. The percentage alone was not a magic switch. It was one part of a structure designed to reach that accounting result. And a sale does something a borrowing never does. When you sell something, it leaves your balance sheet. So, right before the end of each quarter, the moment investors take their photograph of the firm, Lehman moved tens of billions of dollars of assets off the books as sales, used the cash to pay down other borrowing, and reported lower leverage. Then, a few days into the new quarter, it borrowed the money back and brought the assets home. Nothing about the business had actually changed. And the amounts grew. In the fourth quarter of 2007, Lehman used Repo 105 to remove about $38.6 billion at quarter end. First quarter of 2008, $49.1 billion. Second quarter, $50.4 billion, temporarily gone from the balance sheet, right when the market was looking hardest. These figures come from the examiner appointed by the bankruptcy court, Anton Valukas. How much did it matter? The examiner calculated that without these maneuvers, Lehman's net leverage at the second quarter would have been about 13.9 times. With them, Lehman reported 12.1. That gap from 13.9 to 12.1 was the mirage, and Lehman didn't disclose its use of Repo 105 anywhere in its public filings. Inside the firm, people knew exactly what this was. In emails, later collected by the examiner, employees called it a gimmick and window dressing. One wrote that it was, quote, a drug we're on. Lehman's own global financial controller, Martin Kelly, told the examiner there was no substance to the transactions. Valukas summed it up as $50 billion of transactions with no business purpose. And here's the part that lands hardest. Lehman paid a premium to do this. It cost money to look safer. So come back to that opening contradiction, because now it means something. Wednesday, September 10th, 2008. Lehman announces its liquidity pool is holding steady at about $41 billion. 48 hours later, on Friday, it has less than $2 billion it can readily turn into cash. $41 billion didn't vanish through ordinary spending. Much of what Lehman counted was already pledged or otherwise not readily available when the firm needed cash. To see why, rewind to the summer. On June 9, 2008, Lehman pre-announced a quarterly loss of $2.8 billion, its first since becoming an independent public company in 1994. It moved fast to reassure everyone. It announced plans to raise about $6 billion in fresh capital and pointed to a liquidity pool of $45 billion, which it called the largest in its history. A large pool of genuinely available liquidity is what reassures short-term lenders that they'll be repaid. But starting that summer, the cushion quietly changed shape. To keep processing Lehman's trades, its clearing banks began demanding collateral. In June, Citibank required a $2 billion comfort deposit as a condition of continuing to clear Lehman's trades. Later that month, Lehman posted roughly $5 billion of collateral to JP Morgan, its main clearing bank, in response to an earlier demand. Those assets were now pledged, promised to someone else, and no longer freely available. And yet Lehman continued to count virtually all of them inside the liquidity pool it showed the public. It was the same habit as Repo 105, pointed at a different number. Others did not count it that way. When the Federal Reserve Bank of New York calculated Lehman's liquidity for its own purposes, it excluded the assets pledged to clearing banks because Lehman could not freely monetize them. Lehman's public calculation did not make that subtraction. So quarter after quarter, the reported pool looked stable, even as more of what sat inside it was constrained or already spoken for. Which brings us back to Wednesday, September 10th. Alongside that $41 billion liquidity figure, Lehman pre-announced an estimated third-quarter loss of $3.9 billion and about $5.6 billion in write-downs. The message was, the losses are bad, but our cushion is intact. The market was no longer behaving as though the cushion were intact. Counterparties demanded more collateral and became less willing to extend or roll over Lehman's short-term funding. By Friday, September 12th, Lehman had less than $2 billion in assets it could readily monetize. It didn't have enough to open on Monday. Over that weekend, regulators pushed for a rescue. Barclays wanted a deal, but it couldn't guarantee Lehman's obligations before getting the shareholder approval British rules required, and the UK regulator would not waive that requirement. American officials, meanwhile, would not provide the public backstop that could have bridged the gap. Without either guarantee, the deal could not close. Bank of America looked, then bought Merrill Lynch instead. In the early hours of Monday, September 15th, 2008, Lehman Brothers Holdings filed for Chapter 11 in the Southern District of New York, case number 08-13555. So what actually killed Lehman? Bad assets alone don't explain it. Plenty of firms held bad assets in 2008 and opened on Monday. Lehman financed investments that needed years with money that could leave overnight. Repo 105 made its reported leverage look lower. The liquidity calculation made its available cushion look larger. Neither one created the underlying losses. What they did was obscure how little time Lehman had left. The examiner did not decide liability. He identified what he called colorable claims, with enough legal and factual support to warrant a court's consideration, and noted that the Repo 105 transactions may not have been inherently improper. His findings concerned disclosure and internal controls, not a verdict. The control failure comes into focus when Valukas traces who relied on whom. Richard Fuld relied on his finance chiefs and his top lawyer. Aaron Callan relied on a sub-certification from Christopher O'Meara. Ian Lowett relied on Callan's. The auditors relied on management. The lawyers relied on the executives. When the examiner asked who was responsible, the consistent answer was that it was not my job. Lehman's numbers passed through all of them. Responsibility for those numbers, apparently, belonged to someone else. If you got something out of this one, leave a comment, hit like, and subscribe. There's a new case file like this every week.